one of the things that, for those of us who've been in fintech for perhaps before it was even called fintech, is like many other sectors, we love buzzwords and we love to gravitate towards themes, some of which are quite esoteric, but some of them can actually end up being quite real. And we've seen, certainly if anyone has attended Money 2020 over the last couple of years, you will have heard this term embedded lending many times, and we hear it, and if you're on LinkedIn, you probably see it 5 times a day. So, in fact, the way I'm going to approach this for the panelists is that this is an overused term describing many things that are not even embedded lending by any real rational definition. And so when I'm going to ask the panelists to introduce themselves, they're going to do it in a way not so much about themselves but their company, and describe their company and prove that they're actually embedded lenders. So that's the challenge, and I guess Ardalan, given that you're to the left of me, you get to go first.
Sounds great. Thanks. Hello, everyone. And I was joking outside that if I say generative AI and embedded lending, they're such hot buzzwords, there might be an alarm that goes off with venture capitalists looking to
term sheets, money at they're coming in.
So I will understand if folks aren't familiar with FIG Financial. We only launched publicly March this year. And since then, we've been quite busy. We've been growing to surpass volumes that some of the prime lenders in this space that have been here for a few years have been to. And as much as I'd like to take credit, I lead risk management here at FIG Financial. I think we really attribute it to embedded lending. And so, I'm quite pleased to be joined by some of the pioneers in embedded lending from Affirm and Finance It. But if you allow me for a few minutes, I'll just take a moment to describe FIG. And at its heart, we're a company backed by Ontario Teachers Pension Plan as well as Fairstone Bank. And our core offering is personal unsecured installment loans through digital channels and embedded lending. So what does that mean? So for our business partners, what we do is we enable them through our API to insert product lending directly in their platform. What that means is they can take their existing clients as part of their client journeys and monetize that by providing them lending solutions.
Ardalan, sorry to interrupt, but when you say insert, I think you actually mean embed, right?
Embed, right.
Okay,
very on brand. And so through that, and it's seamless to the clients. I think someone in the previous panel called it applicationless, but this is a way for them to understand what they are pre-approved for, not the wide range that they qualify for, but what they actually are approved for, the loan amount, the interest rate, and they can take that on quite easily. And so, said another way, it allows our business partners to monetize their client journeys, which is quite important in this economic environment, but also in a way that's no added risk to them. So FIG will take on all of the capital, which again is quite tough in this environment, but we'll take the capital for the loan, credit underwriting, fraud underwriting, regulatory compliance, customer servicing, collections, all of that end to end we'll take care of. And now from the other side, the customer side, this is making it as easy and accessible as possible. They get access to custom tailored offers that they don't have to not only leave their house to get it, but just even with the platform that they're in, they don't have to click out or do anything like that. It's all embedded directly into the platform solution. And so I can go on. I know we've got some great panelists, so maybe I'll pause there. But before we go deeper in the conversation, just wanted to explain part of what we do, and hopefully that explains the link to embedded lending.
Is he embedded lending? Show of hands. Not bad, right? Okay. Michael?
All right, this is a test. Wow. Michael Garrity, CEO of Finance It. Finance It is Canada's largest point-of-sale financing company. Point-of-sale financing implies embedded. I mean, I should win already, but I'll keep rationalizing. So we'll do about $1.6 billion this year, approximately. We've got a book size of about $4 billion. We're obsessed with point of sale, right? So the whole concept is of embedded lending should be, and this is me being judgy, embedded lending should be about your payment function is facilitating a purchase in the most virtual way possible. It's kind of that simple. So home improvement is our main sector that we focus on, really complicated sector where someone shows up to your house and gives you a quote and then schedules a time and then you get 3 quotes and then there's multiple stages to drawing payment. So there's an upfront payment oftentimes and then a midterm payment and then completion of job. They've got to order products and services. So lots of stuff going on, very complex. So our job is to make it simple, right? And to really not be getting in the way of a transaction. Embedded lending is about facilitating a transaction, not getting in its way. So our salespeople are the people that come to your door. They articulate a $15,000 furnace replacement as $199 a month. And by the way, don't even pay for 6 months. And that's it. That's the articulation of the offer. And then a few clicks of a button, a few pieces of data, all on a mobile device, and the terms are set up. So that's how we rationalize that we're embedded lending.
Michael, what do you think that that offer of turning, say, a $15,000 purchase in your example into 100 and whatever a month, what does that do in terms of enablement and sales, really? Like, because that's really what it comes down to. It's a sales or marketing tool, but anecdotally, how do you see that manifest itself?
So there are 3 metrics that we often will tell our merchant community that the benefit of using our products and services. We increase close rates, right? Because we just made that really simple for you. And I'm sure a firm has a very similar view on the world. You radically increase the close rate. You radically increase the amount that a job can be. So if it's 15,000, but if you get the environmental version, it's 21,000. That's a $6,000 difference, but the difference from a payment perspective is $199 to $232, right? And so you can upgrade people to higher product and a larger ticket size as a result of that, and you increase your sales efficiency, right? You roll less people to go to less homes, so there's an efficiency gain for the merchant in that product use.
Okay. So I think I'm going to give you a check mark on embedded lending.
Hey,
yeah, it's not bad.
Got a check mark.
Okay, Arena.
All right, I'll try to get my check mark as well here. So Affirm is one of the, I would say, largest in North America buy now, pay later players. Mind you, this concept has been, I would say, in the market in the world long before buy now, pay later has emerged. So having said that, our concept is partnership with merchant. This is our primary source of how we view embedded lending at the end of the day. And I will use the word seamless. This is about removing obstacles. I really like how Michael put it. It is about seamless experience at checkout, at point of sale. So how do we combine together that credit experience with purchasing experiences and at the end of the day enable consumer to get the product that they need. So our partners, merchants, so some of them you know quite well, Amazon, Shopify, so through them we partner with multiple merchants. In Canada specifically would be Apple, Samsung, and others. So we are solving for this problem together with merchants. So this is where we embed ourselves into their checkout experience and helping consumers to get the goods that they need. So the key here is to provide that seamless experience where consumer can understand the terms, can trust the terms, and be sure that they can afford what they're trying to buy. And at the end of the day, have a happy path, happy experience of obtaining these goods. And at the end of the day, merchants are our customers as well, not just consumers. We need to ensure that we help them to increase conversion rates, increase that penetration.
Okay, I counted at least 2 embeddeds in there, so that's good. Yeah, it sounds like embedded. So let's keep on this theme a little bit of embedded. And when I look at these 3 companies, I can see that neither of you are banks. So I guess the question I would ask is, why is that? So why is it that fintechs are doing this and banks are not? Or maybe this is a small data sample, but maybe Arina, do you want to take that one on?
Yes, I'll try. I can say why we chose not to be or yet not to be. So this is kind of always a question. So I would say, yes, we're here not banks, but I would say banks are also present on checkout through their credit card product, for example, right? But if we look at it, the experience of credit card is somewhat different. So the adjudication for credit card is taken out of that process. So banks take their time to decide about overall consumer, not attaching it to a specific purchase outside of that embedded process. In our case, we are there at the time when sale is happening. We need to make a decision on a specific consumer right there, and as seamless as possible. And it's not an easy task. So it's all coming to the question of data availability, technology availability, and how to make it simple enough yet within the risk appetite. So, and this is the main theme. The risk appetite of the bank versus alternative lenders is quite different. The regulation imposed on us versus bank is quite different, and all for the right reasons. So we do have more, I would say, wiggling room very frequently than a traditional bank to experiment with what we do at checkout, how we approve that consumer.
So are you suggesting then that the risk profile of what you're underwriting is different / higher than what a bank would underwrite through a credit card, and therefore the banks either can't do that or don't want to do that?
I would say those who apply probably look the same, but those who get approved might look very different. So, and not just a mix, but also their journey to get approved looks different. So in some cases, we have to get into the tails of customers that bank might not have gotten with. So also requirement for the KYC. So earlier panel touched on KYC quite a bit, right? And the fraud discussion that is happening here. So what kind of information is available for us to be sure that the consumer is who they say they are? So how much of a wiggling room bank has versus us, it's a different story.
Okay. I want to pull on the thread of risk because that anything in fintech, for those that are in it, those that are outside of it, that always comes up in a discussion. Michael, maybe kind of set the record straight, maybe, or I'm sure you, like me, are not short of opinions on things. So, and we love avenues to display that. But if we sort of said that this sounds pretty risky, right? And Arena, like, even with what I know, sort of made me think, wow, that sounds pretty risky, actually. So what risks are the same risks that you would say kind of in traditional lending, and then what are the new risks that embedded lending can really impose or really kind of, you know, be quite concerning for those like looking at this?
All right, well, I'll merge that question into my response from the question before as well, which is why there's a certain cohort of people that are doing this, that point of sale is predominantly non-financial institutions. But I'll caveat that by saying we have a great set of financial institution partners. They are the holders of every single one of our loans. All of our loans that we originate, all $1.6 billion this year, will be held by some regulated financial institution on the back end, essentially. You know, or some other entity that is in the business of buying and holding loans, right? We just launched a securitization facility, our first securitization facility, so there'll be other capital markets players who will now also be participating. But
congratulations.
Yeah, thanks. Yeah, we weren't allowed to press release it, it's a separate issue. Anyway, so all of our secrets today. So I think that the distinction, we have prime and super prime customers, those are the only customers that we take. Everyone qualifies for a bank loan. Most of our clients, almost all of our clients are homeowners, that we do homeowner verification. So these are all bank customers, right? And so the loan that is held is a good quality loan. There's no additional risk that any of our partners see in holding those loans. The issue is how you got it. Right? And
the origination process.
The origination process and how difficult that can be for a traditional financial institution. Why? Well, your brand is got to be regulated to the back seat. I'm facilitating a transaction for someone out in field. It's their brand that matters. They're the ones who brought the customer to the door. You know, big five bank, sit back, man, and let them do the work, right? Your job is to be embedded in the transaction, not to make your brand front and center. So you got to get rid of your brand. Banks aren't really good at getting rid of their brand. They've all invested hundreds of millions of dollars and think it's their thing. And so it's very difficult for them to put themselves in the back seat. Secondly, your compliance framework has got to loosen up a little bit. Now, if you're a bank, you just crapped your pants when I said that, right? Because you're not in the business
this is a family show.
literally, of loosening up on your compliance regime. But in our world, the person who sells you the loan doesn't work for you. They work for themselves, and we give them a tool that puts them in a box, and they can't do anything nefarious, but they're the ones who are articulating the financial offer to their customer. For banks, that freaks them out, right? This is called kitchen table risk, what a bank would call kitchen table risk. The likelihood that an installer of a furnace is going to blow it and say something about the loan product that's going to ultimately get them in trouble with their regulator. I personally think it's more of a perceived risk than an actual risk, but again, I don't work at a bank, so I'm allowed to say that, right? And then the third thing that makes it hard is technology, right? So you have to have technology that is super easy to use, super small in its application, i.e. someone at a kitchen table that is selling a product and someone that's buying a product, and it's got to be dead simple, and it's got to be secure enough in that external environment that data doesn't leak into the ether, that you don't get hacked, that all those other types of things. Also a really difficult thing for banks to get their arms around, right? They do big well, they don't do small well, as a general rule. So I think there's elements of like risk and why it is that non-bank players have predominantly been the ones who've been successful in this business.
Okay, thank you. Arlen, so you're originating loans completely digitally. You never see the customer. And am I right in saying as well, the third piece, no human in the loop on any decision? Okay. So then the flip side of that obviously gets into the risk discussion. So do you want to kind of talk a little bit about, from your perspective, what risks you see, how that kind of exposes you to different risks? And maybe you can segue a little bit into, because I know we wanted to talk a little bit about data as well.
Yeah, absolutely. And David, we're making risk sexy again. And I know you'll say, when was it not? And I won't fight you on that. But I think in all seriousness, we're in the business of taking risks that we understand and that we get paid for, right? And that I wouldn't draw a line between the banks or us. I think all of us are kind of in that situation. And so, maybe just touching back on the risk management side. So what differentiates us then versus, say, the traditional banks or the big banks in terms of risk management? What advantages do they have? So they have, a broad base of existing customers, right? Whereas a lot of us might be new customers, to your point, that we've never seen. We haven't been able to look them in the face. We're doing it all digitally. And so, we have to factor in trying to leverage as much data as possible to be able to read that. There was a great panel right before this in terms of leveraging AI, but it all, again, starts with the data, so I'll get into that in a second. But on the risk piece, I think the banks have an advantage in they have lots of people that they've already have historical data that they can use to underwrite for credit, underwrite for fraud, and what else they do is demand. It boggles my mind. Last time I applied for a mortgage, I almost cried because of the back and forth and the documents that was required. But they're able to they have the power to demand all that information. And so I think that what that means for us, call us the challengers, call us as embedded lenders, is we're trying to focus on the user experience. But we have to be very careful not to do that at the expense of giving up on the right risk management principles, right? So the underwriting, because, say we don't want to request the hundreds of documents, right? So what do we do in that space? So there is that risk balance, but I also think that's what's led us to have some great partnerships in the ecosystem that the banks don't. I think that's led us to have some unique leveraging of non-traditional data that we're pushing on that frontier to manage that risks. Now, where I might kind of challenge, and you wanted us to be spicy, but I'll say that hopefully we're not differentiating ourselves on, transparency, privacy, regulatory compliance, because, those are fundamental, at least from a responsible lending standpoint, right? And so the regulators, when we talk about them, they'll often say, well, hang on, Canada lasted through the 2008 financial crisis because of the security of the infrastructure. And hold on, you want all these challengers to come in? And so I think what we prove there is to say we actually do it with that transparency, with the responsible lending practices. So I think that those aren't necessarily the ways that you want to necessarily innovate, or at least innovate in a way that add further transparencies. Going back to the data piece, yeah. And I think the ecosystem. I think that's where there's an opportunity, especially folks around this room, to continue to talk to each other, right? Like we've talked about fraud all the time. That we don't want to be sitting back. I think what exists today in terms of the consortium that's led, by the way, from the banks is not good enough. And I think we need ways to crack at that. And that starts with us, if we're more nimble, we're more agile as these innovators, we need to make sure that we have a better ecosystem of leveraging that data and tackling that. But I can go on for fraud for quite a while, so
Me
maybe
too.
I'll
But we won't,
we should
right? Yeah.
talk some more. And anybody else
Actually
who's
less
interested,
sexy
come by.
than
and-
risk. If risk is sexy, I don't know where fraud fits, but it's probably not as sexy.
The beauty is risk is broad, so there's a lot of layers.
Okay, let's go back up a little bit more in the clouds, back to embedded lending, and a question for Irina, because Affirm is really operating in many different countries. And so it would be good to have your perspective on embedded lending in Canada and what you're doing here, say, versus what Affirm's doing in the US and elsewhere in the world, and maybe how that contextualizes a little differently as embedded lending.
Yes, absolutely. It's a very good question, actually. So we have huge opportunity here in Canada. So as I believe first panel mentioned that people bank with the bank of their parents, right? So this is truly the mentality of people. And the reason why it's happening, kind of how I see it, is the trust, or rather lack thereof. So how do we, as alternative lenders, make consumers comfortable with our offering? So we need to really understand that psychological thread where people know that they can rely on that brick and mortar that they see. They trust the brand. Also, beautiful presentation from Equitable Bank. It's about the recognition. So people know that they can rely on traditional. They know what to expect. Even though credit card might be actually more pricey than term loans we're going to offer, but they know what to expect from that relationship. This is definitely something big in Canada. And in case of alternative lending, again, we're not regulated in all aspects. Some lenders end up in predatory practices. Some lenders end up with surprising their customers with fees, surprising their customers with the conditions, with some other fine print in the contract. And this is what holds us back in Canada, holds back our innovation, our partnership, and our expansion. In US, for example, where we are very large in that market, and our US market overall is quite big on utilizing, Australian market is quite big on utilizing buy now, pay later. UK market is quite big, right? So in Canada, we are substantially behind. So it is definitely a great, huge opportunity for us, but we need to do it right for us to penetrate that space. So for example, at Affirm, one of our values is no fine print. Our mission is to bring honest financing to people.
What's the smallest font you use then? When you find print?
Actually, it's quite big font. So, for example, for backbook practices, we don't use late fees. We do not calculate extra interest. So customer always will pay only that amount on financial charges as what we initially show to them. So never extra. Does it cost us? Yes, of course. But this is our core of our promise, and we hold on to it, and we think this is why Affirm was successful in other markets, and hopefully it's going to help us in Canada as well.
So Andrew Moore, I don't know if he's still here, but this morning, to paraphrase him, said, "What's going on here is bullshit," basically. Are you going to go as far as saying that, or you don't have to use that term, obviously? But
yes, what's going on here is quite challenging.
there you go, nice. But Michael, I think, wants to contribute to that. Do you want to segue into the whole open banking minefield, or we just want to kind of keep it high level?
Open banking. I can't go on another stage and call open banking in Canada bullshit. I think I'm just getting repetitive.
Yeah. But back to the question though, is that the main thing? Are there other things? Like when we think about the opportunity set for embedded lending in Canada, and let's we're almost in 2024 now, so maybe think about that. Is that no one's, I mean, anybody who's planning for open banking is, been fired a long time ago kind of thing. So let's think about other things that are going to move the needle.
Unless you're at a big bank and then you're being promoted, actually, because you've done your job in preventing it from occurring. So I'm just being mean. today. All right.
Spicy.
So,
you see,
spicy.
I told you.
You wanted
Come
spicy.
on.
We're 3 minutes
tamales
for lunch.
here.
Well, why don't I widen it out and sort of tea leaf read? and say kind of what's going to continue happening in this space. Well, I was just reading last week, 50% of people polled said they would take a checking account from Amazon if it was offered tomorrow. 50% of Canadians from a retailer would take a checking account tomorrow if Amazon offered it. What does that tell us, right? That tells us that trust in financial services is moving around, right? And that people have a connection, especially millennials, younger folks, who have grown up with the convenience of a mobile app delivering what they want tomorrow by 9 a.m., right? I want a new belt. I'm going to order it while I'm at school, and it's going to arrive before I go to school tomorrow. You probably go to school later than 9 a.m. Separate issue. So that is that world of what's floating around and abstracting where trust is going to sit and where embedding needs to happen of financial services. It's not just lending, right? It's core banking, it's insurance. You just described mortgage and how difficult it is to get a mortgage. Why is it so damn difficult to get a mortgage? Why is there so much paperwork, ID verification, background checks on the home and the title and all of that stuff, that junk that's happening in the background? It's all been eliminated in auto lending, for example. You go and buy a car, you go and buy it from Honda. You don't even know who gave you your financial product. Do you know that Honda gave you 1.9 APR financing and you drove off the lot with
Not anymore, they don't.
Well, they can. It's just very expensive, right? So whatever that offer is, the virtualization of credit, the virtualization of banking services and financial services is going to happen. It's already happening. And so my tea leaf reading is that everyone who's got a core financial product should be thinking about what are my distribution channels, how can I virtualize, how can I get to a convenience point? Because if you're not, somebody else is going to beat you to it. So that's my
Thank you.
high level.
Okay. 22 seconds. Go.
Oh, sorry about that. Just take an extra couple of minutes. Who cares?
Gary's okay
Gary
with that,
will.
right? No, we're standing between lunch, though. Come on.
So specifically, you want me to talk about the...
You can either take the least sexy topic that we were going to discuss related to embedded lending, where risk is here, fraud is here, and then regulation in terms of sexiness, or you can punt that to the curb and continue on with the discussion around thinking about embedded lending and what could be better in Canada.
Yeah, I mean, so maybe I cannot make regulation sexy again, but let's just touch on that. I think one of the interesting areas there is they're focused on strengthening their oversight on the main banking sphere, but mindful, does that push the risk to the peripheries, right? And we've seen that in the mortgages as well, right? The more regulated banks, rules, folks go to the dark areas. And so, what does that mean in our area? And that's why I think, it's important that we continue to kind of maintain a strong risk management posture so that that's not one of the reasons where we're not being supported. So I think what can be done better in Canada, linking the two together, it's around how do we get fair advantages. EQ Bank, Andrew mentioned this morning that the cost that they have for Interac is quite different between the banks or not. And so our regulations providing some of those challenges and barriers, right? Certainly in terms of their requirements. And so, but I think their job is to make sure everyone's equally unhappy, from the big guys to the small guys. So hopefully they continue to do that.
Yeah, unhappiness is a given. We know that, right? Thanks, everyone. We're out of time. Appreciate from the great panelists this incredible discussion, and spicy as it was, on embedded lending.